China just fired a financial bazooka, a move so bold it could send shockwaves through the global markets. But here's the real question. Will it be enough to save their crumbling economy? And more importantly, what impact will this have on assets around the world? What happens to U.S. stocks? What happens to real estate? What happens to Bitcoin? Now, we know that in the past, what's happened when China's economy has seen similar crashes, and what's happened to asset prices around the world. And right now, China's central bank is pulling out all the stops and literally pumping in trillions of dollars into their financial system. The monetary bazooka was loaded and it's been fired. So in this video, we're gonna dig into what does China's latest move mean for you as an investor? We're gonna dive into the data to see how similar moves in the past affected stocks, real estate, and Bitcoin. And of course, what you can do to position yourself to benefit from this. And by the end of this video, you're gonna have a clear understanding of whether this monetary bazooka could be your next big opportunity or a warning sign to stay cautious. Either way, knowing how China's actions could impact your assets is going to give you a serious edge in navigating the market ahead. And real quick, if you're new to the channel, my name is Mark Moss. I've been investing my own money and I've been building companies now through 4 economic crises. I've been writing a financial newsletter and coaching thousands of investors for almost 9 years, and I'm a partner in a leading Bitcoin-focused VC hedge fund. And a lot of the research that we use is going into this video, so let's go. All right, so we're gonna just jump right into this because this is hot news and this is massive. It's drastic. It's something I've been talking about for a long time and it's here. Okay, so hopefully you've been ready for this, and if you're not, don't worry, we're gonna catch you up. So why? Why do we have a monetary bazooka in the first place? And of course, it's because China is struggling. China's in trouble. And of course, when China's in trouble, the rest of the world's in trouble. Maybe that's why the Federal Reserve is acting. We'll come back to that in a minute. But basically, China has been in big trouble for a long time. It's nothing new. China has been goosing, faking, stimulating their economy for a long time, which of course has adverse effects. And lately, it's finally been catching up. So here is China's 10-year yield that they pay out on their treasury. And look at that is what we call deflation. Now, if you follow my channel or you're paying attention to macroeconomics, you know that central banks around the world, the entire system, because we're in a debt-based monetary system, needs inflation to survive. It's a Ponzi. If it doesn't continue to expand, it crashes. And deflation is the number one fear that all central bankers stay up at night worrying about. And this is what China has been seeing. Now, that is their bond, that's their yield, their 10-year bond. Here we have this is their stock market going down compared to the S&P 500, the US market going up. This is a bad sign. And again, not just for China, but for the rest of the world. Why? Well, turns out the US needs the Chinese economy, just like the Chinese economy needs the rest of the world. We can see this really in the real estate sector. You've probably been hearing about it. I've done videos on it. The real estate sector has been getting completely hammered. Here's real estate sales. Here's real estate starts. Again, massive deflation. Again, this is what keeps central bankers up at night. And we can kind of keep going in. This is another big problem that China has. China's got a lot of problems. So while they're apparently, to people that are not paying attention, taking over the world, when you just kind of peek under the hood, you see they've got serious problems. This is the unemployment rate, China's youth unemployment rate, as a matter of fact. We're at greater than 20%. 20%. I'm going to pause on that. The U.S., you hear about all these jobs being lost, unemployment's going up, but we're like at 4%. 20%. It's a big deal, especially when it comes down to the youth, especially when it comes down to the men. So China has lots of men. They had a one-child policy for about 3 decades where they didn't have girls. All they had was men, and now they have hundreds of millions of men with no girls, and they have no jobs. It's a big problem for China, as you might imagine. So this is sort of the place that they've gotten them in. One more chart to show you the deflation. This is the money supply. This is M1. And again, look at that trend. It's big news. So China's been in a bad place for a really long time, which has caused drastic times calling for drastic measures. Okay, so now they've got the monetary bazooka. Boom, they shot this out into their economy, but of course it's the global economy. Now, the bazooka, it's massive. Before we get into the specifics of the bazooka, we also want to understand what happens as all of this goes through, and more specifically, what's happened in the past when we've seen China do this. It's not the first time. As a matter of fact, This is the fourth time in just the last several years. Okay, so what happened? So first of all, let's just break this down. Basically, they're doing every kind of monetary stimulus they can, basically trying to expand the money supply. How? Well, they've cut bank reserve requirements. So basically, they're cutting rates and cutting the reserve requirements so the banks are able to lend out more money. Actually, I have a whole breakdown right here. Let's run through this. Before we run through that, let's just take a look at some of the things that we see in China. So, for example, this rollout shows, this is a very big piece, but it's so big, I'm going to come back to it. Let's look at this. Let's look at the specifics real quick. What we can see is that PBOC lowered reserve requirements by 0.5 point, which doesn't sound like a lot, but it is. And the reason why is because by doing that, they unfreeze or they unleash about 1 trillion yuan, which is about $142 billion for the banks. That's massive. They did a 7-day repurchase rate reduction from 1.7 to 1.5. Again, another massive drop. They changed or lowered the loan prime rates by 20 to 30 basis points. So basically, they're making money cheaper. And again, right, when money's cheaper, the goal, hopefully, people buy more of it, right? Increase loan amounts in a debt-based monetary system. They cut interest rates on existing mortgages by an average of 50 basis points. Imagine in the United States or whatever country you're in, if they just said, oh, everybody's mortgage rates is 0.5 point cheaper. Or imagine what that would do. They lowered the minimum down payment for second homes from 25% to 15%. Imagine if they did that. Imagine how many more people would get those investment properties they always wanted. That's exactly what they're trying to do. The central bank introduced cheap loans to local governments for buying up unsold properties, covering 100% of the loans. So China has this massive problem with all this real estate they built and hasn't been purchased, and they're basically saying, hey, local governments, we'll just give you as much money as you want to go buy all the properties, and we're going to give you 100% of the money. If the government gave you 100% of the money to go buy a bunch of properties, do you think you'd do that? And you understand exactly what's going on. Liquidity for the stock market, this is a pretty big one. The PBOC has launched 2 new tools to boost liquidity for equity markets, a $113 billion swap program, and to fund and access liquidity for purchasing stocks. The PBOC, the central bank, is literally giving hundreds of billions of dollars for them to buy stocks and prop up the market. $42.5 billion in loans to commercial banks for stock market interventions, or maybe we'd call them manipulations, whatever you want to call it. So this is sort of the specific of what's going on. You can understand it's a big deal, a really big deal. Why is this even a bigger deal? It's a bigger deal because it shows intent. If you've been following me for a while, you know that I say that since 2008, the market's changed, and you can't look previous to that to extrapolate a lot of information. One of the big things that's changed was the introduction of quantitative easing, but more importantly, it was a psychological shift. You can't really measure this. I mean, you can, and we can go through that, but it's a psychological shift, and it shows the willingness that central banks and governments have to intervene in markets. And with quantitative easing, they've levered up the system so hard they can't allow it to unravel. Then in 2020, we've seen that escalate, right? In the U.S., it was about $11 trillion of stimulus to prop up the markets. China was even bigger. The question you might ask yourself is, if they did all that in 2008, and then did even more in 2020, and then in 2023 in the U.S., right, we had 3 banks collapse, hundreds of billions and more to save the banks. Why would they stop now? Ask yourself that question, and this exactly answers that. It says, the publicized rollout showed authorities are taking seriously the warnings that China risks missing its growth target of around 5%. So they want to grow by 5% a year. That's their target, and they're afraid they're not going to make that target, and they're taking that seriously. They're doing everything they can to stay on track. The policy barrage likely puts that goal back within reach, so they want to maintain or sustain that growth rate at all cost, no matter what. Do you see what I'm talking about? This is a psychological thing. It's not just a data thing. It's what a lot of analysts miss, okay? Authorities have yet to unveil more forceful measures to boost demand among consumers. So they still have more in their back pocket, is basically what it's saying here. It says right here, more needs to be done in order to help solidify fourth quarter growth. So they still need to do more to stay on that 5% target by the end of the year. So what they're saying is that they are going to stay on target no matter what, whatever it takes. This barrage, this bazooka that they fired is only just the beginning. They have more forceful measures and more needs to be done, and they're willing to do whatever it takes. Now, it's something called the sunken cost fallacy. Once you've gone so far, it's harder and harder to quit, right? Once they've pumped in hundreds of billions of dollars, why would they stop now? And you're starting to understand where this world is going, which direction we're heading. I want to take a second just real quick to just give you a reminder. The reminder is take control of your Bitcoin. Look, for the first time in history, we have a way to preserve our property, take custody of our property and protect it with no cost. You can't do that with gold. You can't do it with your stocks. And so we can do it with Bitcoin, and you should. Now, don't store it on an app on your phone. That can get hacked. What you want to do is use a hardware device, something like this Trezor right here. So basically, your private key sits here. When you want to do a transaction, you plug it into your computer, sign the transaction. When you're done, you unplug it and put it back into your safe. I've used Trezor for now, 6-7 years because I think it's the easiest one to use. I've tried, I think, pretty much all of them. And it's also open source, so you can trust the code. And again, it's easy. Why easy? Because if it's too complex, it makes me think of how many potential holes and risks there could be, not just in the device itself, but even in my own ability to secure it. So I want something fast, I want something easy, and I want something safe. That's why I use Trezor. And if you don't use Trezor, use something. Please get your Bitcoin off the exchange. Use a hardware device to secure your private key. And if you like Trezor, check out the link down below. Okay, now, I want to just jump back in time, not that far. We're going to jump back in time to about 6 weeks ago. And I made this video right here talking about a meltdown or magic setup. And I was talking specifically at this time about what was going on with the Japanese markets, and the carry trade was blowing up. You might remember that video. Let's go ahead and put it right here. We'll link to it in the show notes down below as well. You should probably go watch it. Now, you might remember at that time, the whole world was calling for, this is it. This is the final prick in the liquidity bubble. The whole world's going to crash. Of course, I made a video calming you down, and I talked about global liquidity and, again, how this always continues to expand. Now, at that time, I showed you this chart. I've used it many times. If you watch my channel, you're familiar with this chart. And this basically shows that all the debt in the world, about 75% of it, 75% of the world, has a maturity rate of about 1 to 5 years. So let's call it a 4-year average. So about 75% of the debt in the world has about a 4-year average. And remember, the debt can't get repaid. It can't get destroyed. It gets rolled over. We need more debt to pay the existing debt. So you might remember this. So every 4 years, we have to create more debt to continue to roll it over, which is why we end up on these 4-year cycles that look like this. This is what it's supposed to look like. Of course, it doesn't match perfectly, but it pretty much does. Now, you can see that right now, the global liquidity is turning up right on pace. Now, again, these 4-year cycles started in 2008, because that's when the whole world went to zero rates, and they just so happened to coincide with the 4-year business ISM cycle and the 4-year election cycle. Oh yeah, and the 4-year Bitcoin halving cycle at the same time. Pretty interesting, isn't it? But you might remember this video if you saw it. Let me just play you this clip from this video from 6 weeks ago. Now, the problem is that, and what we've seen going on, is that we're in this what we call like a liquidity pocket. There's debt that needs to get rolled over. The world needs the Fed, the central banks, the Fed of the United States, but other major central banks. Other major central banks are the ECB, European Central Bank, the BOJ, Bank of Japan, and the PBOC, the Chinese Central Bank. Those are sort of the major ones. And what we can see is that they need liquidity, because they need to keep their markets or their debt rolling over to keep their markets going. But the problem is that the world has been, the Fed has been in a tightening cycle. So they want to tighten up the monetary supply, but right now the other nations of the world needed to start easing so they can get that liquidity so they can roll that debt over. Now what's happening is China desperately needs this, but they can't go into an easing right now while the Fed is still in a tightening. All right, so what did I say there that was so prophetic? I said that all the central banks need to ease in sync. And what happened is that two of the most important central banks in the world, Japan and China, they really needed to ease, like really, really bad. Japan couldn't wait anymore, so they moved without the Fed, and it almost crashed the entire globe. So Japan said, whoa, okay, we'll wait for the Fed. So we needed the Fed to announce easing, which they just did. And just like we talked about 6 weeks ago, the Fed announced they would ease, And now the PBOC is doing it because all this needs to be done in sync. They were waiting. And so we have all the major central banks of the world easing. We also have Switzerland easing, Canada easing, Sweden easing, the Eurozone easing, UK is easing, and again, the US is easing. That means the rest of the world is. Okay, now let's jump back in history because, again, we don't invest in the markets as we want them to be or as we think we can, as they should be, or what our gut or emotion tells us. We need to get the emotion out of it. Let's look at the data. All right, so let's go back in history to see when this happened before. Now, we know in 2015 to 2016, the Chinese stock market crashed really, really hard. All right, we know that in 2018 to 2020, it also crashed as well. There was this trade war going on. You might remember Trump and the tariffs and all of those things happening, which again crashed the market. And again, the Chinese market has been trying to deleverage for a long time. That's what crashers are. They're trying to delever the system, which of course we can't have. We saw it happen in 2021. If you remember in 2021, they cracked down hard on technology and real estate as well. They were trying to kind of slow the bubble in real estate down, and they cracked down too hard. You might remember that. Now, what's interesting about this is you might remember I made this other video about 6 months ago, and I talked about this phenomena called the Imperial Circle. Now, it's the George Soros Imperial Circle. A lot of you guys might not like George Soros. I certainly don't. Just forget about his name for a minute. It's about the secret circle, the Imperial Circle. And basically what this tells us is that money moves globally. And the irony of what happens is when the United States goes into a rate hiking cycle where they're trying to slow or tighten the economy down, by raising rates, it pulls liquidity from the rest of the world. And so it sort of negates what they're trying to do, right? So they raise rates, and then it makes it more attractive for money from other countries to come in. And so what we're seeing, you have to remember that money moves globally. So when the Chinese market becomes restrictive or money starts leaving, where do you think it goes? If you guess the U.S. markets, global commodities, yes, you might be right. So we can see this. Let's take a look at these 3 data points in time. Let's take a look at, let's look at this chart here first. This is the S&P 500, right? So this is the U.S. stock market. It's like the main index, the benchmark that we look at. So during the first period that China had the same situation happening, during that same period, we saw the S&P 500 up about 9%. Not major, but it didn't lose money. It went up. That was actually pretty good for U.S. stocks. The second time, 2018 to 2020, we saw the S&P 500 go up by almost 20%. That's pretty good in a short period of time. We average, 8% over a 50, 60-year period. It's pretty good. The third time it happened, the S&P 500 went up over 20%. Again, so as China is restricting the market, so their markets are stumbling, the money's coming to the U.S. Now, that's the U.S. market. That's the S&P 500. What about a global asset like commodity like Bitcoin? So we can see in the same period, the first time, Bitcoin went up by 365%. Pretty good. Better than the 8% the S&P 500 did. The second time it happened, Bitcoin went up by 92%. Again, almost double your money. Not bad. And the last time it happened, Bitcoin went up another 90%. So you see, what happens is as they're easing, they're bringing out the monetary bazooka, so to speak, right? They're going to be putting billions, trillions of dollars in an economy. How much of that goes into other assets like Bitcoin, other commodities, as well as how much comes to the U.S. market? And now you have an idea. All right, now the important thing to understand is that a rising tide lifts all boats, so to speak. And so we're not seeing the the bubble in assets. What we're seeing is the bubble in the denominator or in the U.S. dollars. So really what we want to do is we want to follow the money, right? So just because the Bank of Japan or the Bank of China or the ECB, European Central Bank, just because they're printing money doesn't mean that it's going to stay in that region or in those banks, right? It's going to go around the world. So we want to follow the money. We want to understand that these easing policies, lowering rates, lowering reserve requirements, lowering down payments, things like that, it's increasing the money supply. When money gets cheaper, people buy more of it. Just like if Apple announced that the new iPhone 16 was on sale for $10, would they sell more of them? Yes, of course. We want to understand that different assets have different sensitivity to the rates and the increasing liquidity, right? I go over this all the time. So we know that the S&P 500 and U.S. real estate goes up at about the rate of monetary increase. We know that gold goes up about 1.5 times that. We know Bitcoin goes up at a 9 times sensitivity. So not all boats go up at the same speed. We want to understand that different assets have different sensitivity rates. Now, as for Bitcoin itself, we also want to understand there's a lag. All right, I just did a video on this showing how when global liquidity breaks out, Bitcoin has a lag. We'll link to that video down below. If you want to understand the time frame of when you can expect Bitcoin to take off, go watch that video. And then overall, the assets that I think are the best to invest into during this period follow what I call the quantum wave cycle, which is a 50-year technology cycle, and you want to be investing right there. I'm going to have a live presentation, I think next week, where I want to break down all those assets. It's free if you want to come hang out, ask me questions. We'll put a link to it down below. But just know that as this money is being printed, and we have just started to see it, as I said, China said that a lot more will be needed just to get them through Q4. The Fed hasn't even started yet. And so if you're not prepared for what's about to happen over the next 12 to 15 months, you better get ready right now. And you can start by joining me next week live. There's a link down below. Or you may want to just watch this video about the investing black hole right here, and that'll help you. That's what I got, all right? Give me a like if you liked it. If you don't, you can give me a thumbs down. That's okay. Either way, tell me why in the comments down below. That's what I got. To your success. I'm out.